This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, June 30, 2026, and this is the After Hours session. Now, let's get into it. The Fear and Greed Index is pinned at a suffocating 14 out of 100. We are in the eye of a safe haven storm, where capital is fleeing risk assets and rushing into the US dollar and gold, leaving commodity currencies to bleed out. The VIX has stabilized at 18.41, but that number masks the structural squeeze building in the background. Let's look at what the data is screaming. Before we dive into the currency flows, we have a tight calendar ahead. Wednesday brings the ADP employment report and the GDP Now estimate, high-impact gauges that will test the resilience of the labor market. Then, on Thursday, the non-farm payrolls drop. These are the critical data points that will dictate whether the Federal Reserve's higher-for-longer stance holds firm or cracks under pressure. A miss on non-farm payrolls could trigger a violent unwinding of the current positioning, while a beat reinforces the dollar's dominance. Here is the market overview as of 1913 ET. The US dollar is the clear winner in this risk-off environment. The trade-weighted DXY sits at 120.89, down slightly on the week, but leveraged funds are net long it by 4,438 contracts. Gold is holding near multi-year highs at 3,973.75, though it has pulled back from its 5-day high of 4,096.13. Meanwhile, the euro is struggling at 1.1399, and the pound is under pressure at 1.3234. The fear index at 14/100 tells us that investors are not just cautious, they are defensive. Let's get into the noise. We have several headlines moving the dial. First, Politico reports the US is expected to remove the export ban on Fable tonight. Second, the IMF states that the oil shock torpedoes NZ recovery, sends inflation surging. And third, Bank of England Governor Bailey says the bank won't rush to raise rates on oil-driven inflation spike. Let's hear from Pulse on the policy divergence here. The divergence is stark. On one side, you have the Fed holding the line with CPI at 4.17% and a funds rate at 3.63%, forcing a hold stance because inflation is sticky. On the other side, the Bank of England is explicitly dovish, with Bailey refusing to rush hikes. This policy gap is why cable is trading down 0.15% to 1.3234. The market is pricing in a scenario where the US keeps rates higher for longer while the UK pauses. That creates a structural bid for dollar against pound. What about the commodity currencies? The IMF headline on New Zealand is brutal. Kiwi dollar is down 0.18% to 0.56482. Aussie is also weak, down 0.18% to 0.68701, despite a manufacturing PMI beat of 51.5. How do you reconcile the data beat with the price action? That is the definition of a risk-off regime. The 51.5 PMI is a domestic strength signal, but it is being drowned out by the oil shock narrative. When investors are fearful at 14/100, they don't buy AUD on a PMI beat. They sell it because they are rotating into safety. The commodity currencies are being treated as risk assets, not inflation hedges, in this specific environment. The price action is telling us that macro fear outweighs microeconomic data. Let's move to the technicals. We have dollar-yen climbing at 162.1855, near its 5-day high of 162.406. Gold is consolidating at 3,973.75, rejecting the 4,000 level. Grid, let's look at the structure. Is dollar-yen poised for breakout, or is gold finding a floor?
Let's look at the price action, not the headlines. Dollar-yen is at 162.1855. It is sitting just 21 pips below the 5-day high of 162.406. There has been no rejection candle on the daily close. The structure is intact. It is testing the upper bound. For gold, gold is at 3,973.75. It failed to hold above 4,000 intraday. The 5-day low is 3,942.2. The The current price is much closer to that low than the high. The technical hierarchy is clear. Dollar-yen is pressing against resistance while gold is pressing against support. The momentum favors the dollar continuation.
And that momentum is backed by extreme positioning. I need to flag the COT data here. Leveraged funds are holding a net short position of 97,092 contracts in yen. That is a massive concentration. We saw a week-over-week change of 98,892 contracts. That is not just a trade, that is a crowded trap. If dollar-yen breaks that 162.406 level, you aren't just getting trend-following buyers. You are triggering a short squeeze from that 97,092 position. The flow data suggests that the smart money is aggressively betting on yen weakness, regardless of the technical resistance.
That's a dangerous level to be short. SPECTER, you're the risk auditor. When you see 97,092 net shorts in yen and a fear index of 14/100, what are you worried about?
I'm worried about the lack of volatility pricing. The VIX is at 18.41, sitting in a tight 5-day range of 16.49 to 20.72. It's not spiking. That complacency is dangerous. You have a slow bleed fear regime. The market is pricing in a soft landing, but the COT data shows a loaded gun. If the Bank of Japan intervenes or if the non-farm payrolls data surprises on the upside, that 97,092 contract position could unwind violently. You are ignoring the latent explosive risk of that short squeeze because you're focused on the 162.406 technical level. The risk/reward for entering longs here is negative because the squeeze potential is so high.
So, grid, you see a technical breakout, but CIPHER sees a liquidity trap, and SPECTER sees a volatility time bomb. What about the euro? Euro-dollar is at 1.1399, stuck near the 5-day low of 1.13334. It failed to reclaim the 5-day high of 1.1434. Is there any buyer conviction here?
There is zero buyer conviction. Euro-dollar is trapped. It closed the previous session at 1.13985, which is effectively the current price. It has failed to break 1.1434. The structure is weak. The 5-day low of 1.13334 is the next line in the sand. Until we see a daily close above 1.1434, the trend is bearish. The price action is respecting the lower bounds of the 5-day range. It's a hold for bears, not a buy for bulls.
And that bearish structure is reinforced by the yield curve. The 10-year 2-year spread is flat at plus 0.3 pp. The 2-year is at 4.1%, the 10-year at 4.38%. This flat curve signals growth caution. The Eurozone is facing that same growth headwind, but without the Fed's hawkish anchor. The divergence between the U.S. higher for longer and the Eurozone's stagnation keeps euro-dollar anchored near its lows. The 1.1399 level isn't just a technical floor, it's a macro ceiling. Let's pivot to the Australian dollar. Aussie dollar is at 0.68701. It's down 0.18%, hovering just above the 5-day low of 0.68653. This is a key level. CIPHER, you mentioned Aussie is strongly bullish in COT data. How does that fit with the price action?
It fits perfectly into the crowded long narrative. Leveraged funds are plus 39,111 net contracts in Aussie. That is a strongly bullish position. But the price is at 0.68701, right at the 5-day low of 0.68653. When you have plus 39,111 longs and the price is testing the low, you have a fragile structure. If that 0.68653 level breaks, those longs become trapped. The flow data shows that smart money is still long Aussie, but the price action is rejecting that bid. This is a classic divergence. Positioning says one thing, price says another.
And technically that divergence is a warning. Aussie dollar is at 0.68701. It is holding above 0.68653 but barely. The 5-day low is the key. If we get a daily close below 0.68653, the structure breaks. Until then, it's a hold for the bears, but it's a watch for the longs. The risk is asymmetric. A break below triggers stop losses from those plus 39,111 longs. A bounce off it requires massive volume. Currently, the volume is favoring the downside.
I'm adding a layer of risk here. The Aussie is being sold off not because of Australian data. The PMI was 51.5, but because of the oil shock headline. The IMF says the oil shock torpedoes NZ recovery, and by extension, the regional risk profile for Aussie. The plus 39,111 long position is vulnerable to a broader risk-off unwind. The VIX is stable at 18.41, which means the pain is slow and grinding, not sudden. That makes it harder for those longs to exit gracefully. They are stuck in a slow bleed.
Let's look at the Canadian dollar. Dollar CAD is at 1.4232, up 0.15%. CAD is at 113.9545. The Canadian dollar is under pressure. What's driving the loonie's weakness? It's the oil volatility. The RBC headline says Canadian GDP is strong in Q2, but trade uncertainty continues. The COT data shows leveraged funds are strongly bearish on Canadian dollar, with 83,377 net contracts. That is a massive short position. The market is rejecting the Canadian dollar despite the GDP data because of the broader oil shock narrative. The dollar CAD level at 1.4232 is being pushed higher by fund flows, not just technical momentum. The 83,377 short position is a structural headwind for the Canadian dollar. We have a lot of crowded shorts and longs. Let's look at the Swiss franc. Dollar Swiss is at 0.80914, up 0.16%. The Swiss franc is weakening against the dollar. What's the flow here?
Leveraged funds are strongly bearish on Swiss franc with 13,816 net contracts. It's a smaller position than yen or Aussie, but it's consistent with the risk-off theme. Investors are selling Swiss franc to buy dollar. It's a pure safe haven rotation. The flow is straightforward. Sell risk, buy dollar. The dollar Swiss level at 0.80914 is reflecting that simple bid for the dollar.
Let's synthesize the dollar-yen situation. We have grid seeing a technical breakout at 162.406, CIPHER seeing a 97,092 contract short squeeze risk, and SPECTER warning about VIX complacency. Apex tie this together.
The macro context from Pulse sets the stage. Higher for longer rates support dollar. Grid identifies the technical resistance at 162.406, but CIPHER flow data and SPECTER risk analysis change the narrative. Grid sees a breakout, CIPHER sees a trap. The 97,092 net short position in yen is so extreme that a technical break could trigger a violent short squeeze, as SPECTER noted. The VIX at 18.41 suggests this is a grinding move, but the crowding means the eventual reversal will be sharp. The data shows dollar strength is real, but the positioning makes it fragile. We are not just watching a technical level, we are watching a potential liquidity event.
Let's look at gold. Gold is at 3,973.75, down 1.3%. It rejected 4,000. Grid, what is the technical structure telling us?
Gold closed at 3,973.75. It failed to hold 4,000. The 5-day low is 3,942.2. The price is closer to the low. The structure is bearish in the short term. The 4,000 level acted as resistance. Unless we see a daily close above 4,000, the path of least resistance is toward 3,942.2. The momentum is downward. The 5-day high of 4,096.13 is now far away. The immediate context is a rejection.
That rejection is driven by the 14/100 fear index. Investors are selling gold for profit-taking at 4,000 and rotating into dollar. The 3,973.75 level is a result of that rotation. The macro environment favors dollar over gold right now. The higher for longer rates make non-yielding assets like gold less attractive in the short term, even in a risk-off regime.
I'd add that the 1.3% drop from 4,015.36 to 3,973.75 is significant. It's a minus 1.3% move in a short time frame. This isn't just profit-taking, it's a shift in sentiment. The fear index at 14/100 is extreme. When sentiment is this low, even safe havens can be sold off if the dollar is stronger. The risk here is that gold breaks 3,942.2, which would trigger a cascade of technical stops. The VIX stability at 18.41 masks the fragility of this level.
We have covered the major drivers. Let's look at the broader market context. Major U.S. indices closed the quarter with solid gains, but the fear index is 14/100. How do you reconcile equity strength with FX fear?
It's a divergence. The equity gains are lagging indicators. The fear index is a leading indicator. The 14/100 score means investors are pulling back from risk now. The equity gains were from earlier in the quarter. The current flow is out of equities and into FX safe havens. The solid gains are history. The fear is present tense.
Final synthesis on the session. Apex, what is the key takeaway for traders?
The key takeaway is that dollar strength is structural, driven by the 4.17% CPI and 3.63% funds rate, but it is technically crowded. Grid flags the 162.406 resistance in dollar-yen, but CIPHER and SPECTER warn that the 97,092 short position creates a high-risk environment for a short squeeze. The data shows dollar is the winner, but the positioning makes it volatile. Watch the non-farm payrolls data on July 2. If it beats, dollar extends. If it misses, the crowded shorts unwind. The current setup favors dollar, but the risk is disproportionate.
To summarize, the fear index at 14/100 is driving a safe haven rotation into dollar and gold, but gold is rejecting 4,000. Dollar-yen is testing 162.406, but COT data shows extreme short crowding, creating squeeze risk. Aussie and Canadian dollar are weak due to commodity headwinds and crowded positioning. The key catalyst is the non-farm payrolls report on July 2. Tomorrow, watch for any shifts in the VIX and whether dollar-yen breaks 162.406. This is ShadowQuant Forex edition. I'm your narrator. Stay safe. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the Tokyo session where we will see how these calls play out. Until then, trade safe.